Welcome back to the Algobot channel, where we break down automated trading strategies for MetaTrader 5, one expert advisor at a time. I'm Algobot, and today we're taking a close look at a strategy called Range Position Pullback. This is a trend-following expert advisor that times its entries using a self-computed range position oscillator, a simple gauge of where price sits inside its recent high-to-low channel. Over the next few minutes, you'll learn how it defines a trend, how it waits for a pullback to exhaust, and how it manages risk once a trade is open. Remember, this is educational content only. Let's get started. Range Position Pullback is a trend-following expert advisor built for the MetaTrader 5 platform. Its core idea rests on a simple observation about how markets move. Established trends rarely travel in a straight line. Instead, they breathe, pushing forward, pausing, pulling back, and then continuing. This strategy aims to step in during those healthy pullbacks, joining an existing trend rather than trying to predict a reversal. To decide whether a trend even exists, the EA uses two exponential moving averages, a fast one and a slow one. By default, the fast average looks at 21 bars, and the slow average looks at 55. When the fast average sits above the slow average and price is trading above the slow average, the strategy considers the market to be in an uptrend, and it will only look for buying opportunities. When the opposite is true, it looks only for selling opportunities. The timing tool is what makes this strategy distinctive. Rather than relying on a standard indicator, it computes its own range position oscillator. This measures where the most recent close sits inside the recent high-to-low channel on a scale from 0 to 100. A reading near 0 means price has pulled back to the bottom of its recent range, while a reading near 100 means it has stretched to the top. This approach may appeal to traders who prefer a structured, rules-based way to join trends rather than chase breakouts. It trades one position at a time on a single time frame and symbol of your choosing. As always, this is an educational breakdown of how the code works, not financial advice, and trading always carries the risk of loss. Let's walk through the exact logic, step by step. On every newly closed bar, the strategy updates three things: the fast and slow moving averages, its range position oscillator, and the average true range, which measures recent volatility. First comes the trend check. For a long setup, the fast moving average must be above the slow moving average, and the most recent close must also be above the slow average. Both conditions together define an uptrend. For a short setup, the fast average must be below the slow average, and price must be below the slow average. Next comes the pullback. The range position oscillator runs on a 0 to 100 scale, and the EntryZone parameter, set to 25 by default, marks the pullback boundary. For a long, the strategy waits for the oscillator to dip into the lower zone, below 25, showing that price has pulled back deep inside its recent range. Then, crucially, it does not buy on the dip itself. It waits for the very bar where the oscillator climbs back out, rising above 25 again. This dip-then-reclaim transition is the heart of the strategy. It signals that the pullback has likely exhausted and the trend is resuming. For a short, the mirror applies. The oscillator must first rise above the upper zone, which sits at 100 minus the entry zone, or 75 by default, and then drop back below it. There is one final filter. The confirming candle must close in the direction of the trade. A long needs a bar that closes higher than it opened, and a short needs a bar that closes lower than it opened. When all conditions align, the EA places its order. The stop loss is anchored to volatility, set at 2 times the average true range away from entry by default. The take profit is then placed at a multiple of that risk, 1.8 times by default, giving a defined reward-to-risk ratio. Once in profit, a two-stage manager takes over. At 1 times the initial risk, the stop moves to break even. After that, it trails behind price by an ATR multiple, aiming to protect open profit while giving the trend room to run. Let's look at the actual MetaQuotes language code that runs inside MetaTrader 5. At the top, we have the input parameters, the settings you can adjust before running the EA. You can see the fast and slow EMA periods, the range period for the oscillator, the entry zone threshold, the ATR period, the stop and trail multiples, the reward-to-risk value, and the position size in lots. Now to the long side. The variable named uptrend is true only when the fast EMA is above the slow EMA and the close is above the slow EMA. The variable named long reclaim is true when the previous bar's oscillator reading was at or below the entry zone, and the current reading has climbed above it. If both are true and the candle closed higher than it opened, the code reads the ask price, places the stop loss a set ATR multiple below entry, calculates the risk, sets the take profit at the reward to risk multiple of that risk, and calls trade.buy. The short side is a mirror image. The downtrend variable requires the fast EMA below the slow EMA with price below it. The short reclaim variable is true when the oscillator was at or above the upper zone and has now dropped back below it. With a candle that closed lower than it opened, the code reads the bid price, places the stop above entry, sets the take profit below, and calls trade.sell. Notice both sides anchor the stop to volatility and size the target from the initial risk, so risk is defined the moment each trade opens. Now let's bring it all together on a chart, walking through both a long and a short trade the way this strategy would see them. On the price panel, you can see the two moving averages, and in the subpanel below sits our range position oscillator, moving between 0 and 100, with the lower pullback line at 25 and the upper line at 75. Look at the opening candles on the left. Price is stepping steadily higher. The fast average is holding above the slow average, and price is trading above the slow average too. That combination tells the strategy an uptrend is in place, so from here it is only interested in buying the next healthy pullback. Around the fourth and fifth candles, the market takes a breath. Price eases back, forming a couple of down bars, and watch the oscillator in the panel below. It slides down and dips beneath the 25 line into the lower pullback zone. This is the deep pullback the strategy is waiting for, but notice it does not buy here. A dip alone is not enough. Now the key moment. On the next candle, price firms up and closes higher than it opened, and the oscillator climbs back above the 25 line. That dip-thin reclaim transition, paired with the bullish confirmation candle, is exactly what the strategy needs. The buy entry marker appears right here. At that instant, the stop loss is placed a couple of ATR below the entry, just under the recent pullback low, and the take profit target is set well above, at 1.8 times the risk. From there, the trend resumes. The following candles push higher, the trade moves into profit, and once price advances by 1 times the initial risk, the stop quietly slides up to break even, removing the initial risk from the trade. Price continues climbing until it reaches the take profit target, and the long trade closes out at its objective. That is one complete cycle: trend, pullback, reclaim, and exit. Now watch what happens next, because the market character changes. After that peak, a strong down candle appears and price rolls over. Over the next few bars, the fast average crosses below the slow average, and price drops beneath the slow average as well. The trend has now flipped to the downside, so the strategy switches to looking for a short pullback entry. Just like before, it needs a counter-trend bounce first. Around the middle of the down move, price pulls back upward for a couple of candles, and the oscillator rallies up into the upper zone, pushing above the 75 line. Again, the strategy holds its patience. A stretch to the top of the range is the setup, not the signal. The signal comes on the next candle, when price closes lower than it opened and the oscillator drops back below the 75 line. That is the short version of the dip-thin reclaim transition. The sell entry marker prints here. The stop loss is placed a couple of ATR above the entry, just over the pullback high, and the take profit target is set below at the same 1.8 reward to risk distance. Price then continues lower with the trend. As it falls, the trade reaches 1 times the initial risk, so the stop moves down to break even, and the ATR trailing stop stands ready to follow price if the move extends. Finally, price reaches the take profit target below, and the short trade closes at its objective. 2 trades, one long and one short, both built on the same simple idea. Trade with the trend, wait for the pullback to exhaust, and let defined risk and reward do the rest. And that brings us to the end of our breakdown of the Range Position Pullback Expert Advisor. We've covered how it defines a trend with 2 moving averages, how its range position oscillator times pullback entries through that dip-thin reclaim transition, how it sets an ATR-based stop and a reward to risk take profit, and how its 2-stage manager moves to break even and then trails. Remember, everything in this video is for educational purposes only. It is not financial advice, not a recommendation, and not a solicitation to trade. Every strategy carries the risk of loss. If you found this analysis helpful, please like the video, leave a comment with the strategy you'd like us to explore next, and subscribe for more MetaTrader 5 strategy breakdowns. You can find more at www.algobot.live. Past performance does not guarantee future results. Trade responsibly.